Our next topic is going to be in opportunity in sector rotation by Mr. Deepak Ramaraju. He is the head of equity, Shriram AMC, with 17 years of experience in equity markets. He developed a proprietary quantamental investment model across all equity funds in Shriram AMC. Prior to joining Shriram AMC, he set up the PMS department at Shriram Way to Wealth Securities. He also worked in GE Center as researcher and has 10 patents to his credit as co-inventor. Over to you, Mr. Deepak.
Good evening. So, Vanakkam Chennai.
Vanakkam.
So today I'll be talking about Shriram Multi-Sector Rotation Fund. This is an NFO coming out of Shriram Mutual Fund. So something unique in the entire industry. For the first time, a new category under the thematic fund is being created by SEBI and something different. So you'll understand how we are different about this. So the main question that we're asking, are you old-fashioned or are you able to capture the trend? Because today everything is changing in the market. The trends are frequently changing. Are you able to capture those trends? So if yes, so you're with me in this journey. So the industry, if you look at the thematic or kind of the sector funds, they're almost grown by 20x in the last 10 years. From 19,000 crores to 4.67 lakh crores. The number of funds have grown by 3x from 59 funds to 185 funds. And close to 50% of the flows in this year has gone towards the thematic funds. So, an interesting category, the largest category today, even surpassing the flexi cap category as well. But the main risk is, if you look at any sector or theme, it will have its own kind of cycles. Main point here is, as investment advisors or as investors, we know when to enter a sector. We have a fair understanding of what's positive happening in those sectors, what the industry trend is happening, and we all know that how those sectors are performing, and we enter at that point of time. But many of us fail to exit at the right point of time, or even recommend to our clients when to exit. Even if we have to exit, the other questions like, what will be the capital gains tax implication on that? And even after that, even if the money goes out, whether the money will come back to this kind of fund. That's another big question most advisors or financial planners will always have. So what if a solution is provided to this? For example, if an investor enters at the right point of time and exits, he makes a decent return. But most of the cases it doesn't happen. They end up in an inertia. So the returns will always get diminished. But there'll always be an investor who ends at a later stage of the cycle. Basically, if somebody comes at the later stage of the cycle, he ends into a sector trap. So, but these cycles keep repeating. It's not only one phase, these cycles keep repeating period after period. Similar story, for example, IT, pre-COVID and post-COVID, similar kind of a story, the sector trap also happens. What if we enter the IT at one point of time and are able to rotate into another sector at the right point of time? Now, the key question is, what is the right point of time? How do you identify that? Which sector you need to rotate? That's the very important thing. And more importantly, if somebody is able to do that successfully, instead of losing 5% by staying invested in IT, you would have made 18% kind of a return. So that's an example we are taking. But now the question is, how do we execute this? And more importantly, if everybody puts all the money in one single basket, that's again a risk. A single sector or a single theme is always a dangerous part. So how do you diversify this? Can we diversify this? To what extent do we need to diversify? If you diversify too much, it becomes a flexi cap fund or a business cycle kind of a fund where you have too much diversifications. Can you be more focused? Can it be like a sector fund or thematic fund? Be more true to the label as a thematic exposure. So in that way, we did a study on that. We looked at the last 10 years of data, 10 financial years of data, April till March. And we looked at all the 19 AMFI-defined sectors within NSE 500, looked at their performance of all the sectors. And we looked at how those sectors have performed over a period of time. If at all, one had picked the top 5 performing sectors at the right point of time in every year, he or she would have made a better return. The bottom gray line, this identifies the top 5 performing sectors. irrespective of the cycle, whether if you look at FY20 or FY21. So the returns made by the investor would have been much better there. The top 5 sectors would have fallen less compared to the benchmark. The next year when the recovery comes, the top 5 sectors would have performed much better. Rather than having a kind of benchmark exposure, you would have had a potential alpha of significant number. So that's a key thing. Now, the 5 sector is a very unique number of sectors to be in, because we did a study who all have kind of done this kind of in the past. Peter Lynch, one of the well-known investment professional, his success story is all about that. How one can beat markets successfully by identifying only selected sectors, stay invested in that, make money on a consistent basis. His mantra was all about that. And there are a lot of literature articles also available, especially journal articles like Journal of Asset Management or Faster Capital. They clearly articulate that, and they have demonstrated that whether in different monetary regime, whether it's a rate hike cycle or a rate cut cycle, any monetary cycle, they're able to beat the benchmark consistently, deliver a significant alpha with just a selective sector rotation and focused sector diversification. That's the advantage one can have by investing only in a selected set of sectors. And Dalal Street also had a kind of article in the month of August, beating the markets with sector rotation. So it clearly boils down to kind of identifying the right kind of sectors. And more recently, if you look at post-COVID, if you look at the market rally which has been happening, we have been seeing frequent sector rotation happening very short in a shorter duration. The cycles have reduced. 1 month you have auto stocks running, few months you have defense, few months you have railway stocks running. So that rotation is quite frequent. Why is this happening? It's because the liquidity is chasing the market. When the liquidity chases the market, we always try to hunt value in the system. We always look at for the which sector is cheaper now, we'll try to park money there. That's what happens. That frequent value hunting leads to sector rotation. So that's where we came out with this kind of a product called Shriram Multi-Sector Rotation Fund. As I said, it's a unique product in the industry. First time a SEBI created a new category into the thematic basket. So other AMCs will follow suit to launch products across in the similar theme now. The main agenda here is avoid sector traps, ride the sector trend. The NFO closes on 2nd December. It's running right now. And from an investor point of view, what are the 3 pain points that we're addressing? 1, rather than putting all the eggs in one single basket, we are diversifying. We are not too much diversified. We are only focused diversification of only 5 sectors, 5 trending sectors, that's all. Anywhere between 3 to 6. And we avoid sector traps by actively rotating from one sector to another when the trend is changing. If one sector trend goes out, we enter into another trend. I'll just give an example in the coming slides. Now, the third main important point, which is the most pain point from investors' point of view. Assuming the investor is too smart, they're able to rotate the sectors at the right point of time. He or she ends up paying capital gains. To avoid this, if they invest in a fund like this, when we do the sector rotation, they don't end up paying the tax. They can allow the fund to be invested and they can ride the wealth creation journey basically. So what's my investment philosophy here? It's a 2-step approach, top down and bottom up. In the top down, we look at the right kind of sectors where we need to invest in. That too, we look at using a quantamental approach. The second step is, once we identify those trending sectors, top 5 trending sectors, we pick the stocks only from those 5 trending sectors using a quantamental approach. So it's the first time in the industry a double quant engine is running. Basically, one quant engine is run at a sector level, the second quant engine is running at the stock level. So you identify the right kind of sectors first. Once you do that, you pick the right kind of stocks using the quant engine again. We keep monthly rebalancing it. The reason is we need to keep the trend active. We need to monitor the trend pretty actively. So that's why we do a monthly rebalancing. What is my sector selection strategy? NSE 500 is my universe. NSE 500 is also my benchmark. There are 500 stocks. We bucketize the 500 stocks under different AMFI classifications. So AMFI has got defined 22 sectors. 22 sector defined பண்ணிருக்காங்க AMFI. And the 22 sectorல நம்ம என்ன பண்ணுவோம்னா, so we allocate all the stocks among those 22 sectors. Then we built index for all the 22 sectors. NSE has got 13 sector indices, but we ended up building the sectors for 19 sectors. We built for all 22, but 3 small sectors were there. One was diversified, one was utilities, the other one was forest material. We assigned those 3 smaller sectors to the other 19 sectors, the other 3 sectors within the 19. So we brought down the number of sectors to 19. And the 19 sectors, we built the index completely. Once we built the index behaves like a stock, basically. It has got its own kind of behavior patterns. It also depends on the government policies. The sector moves in tandem with the government policy. If the government policy is favorable, it moves in that. If the macro environment is favorable, it moves like that. If it's against, it will underperform. So the sector movements or the index movement behaves based on various factors or parameters. So the quant models are able to capture those parameters and identify the trending sector at any point of time. Once we are able to run the quant engine on those indices, we are able to rank the sectors in a descending order. The top 5 trending sectors is what we will be interested in. Once we identify those 5 sectors, we subject to a fundamental analysis. This is the most important aspect of the entire step. Understanding why those sectors are trending on the top. Once we have a clarity on those sectors, why they are trending on the top, that will enable us to make this as investment portfolio. That's where we take it to the portfolio. I'll just take an example here. I've taken 2 sectors basically, auto and auto components and IT. Recently, auto went out of the portfolio and IT has entered in the month of November. Now, for example, I have 19 sectors as I mentioned. I have all the 19 sector ranking that is there. And for each calendar year, there are 12 months. I have the columns on the column wise for the each month of every calendar year. Basically, this blue dot that you're seeing here is the relative ranking of auto sector over a period of time. Over the last 10 years, how auto sector has ranked. There's a particular pattern in which auto has performed. For example, 2018 onwards, the entire auto sector started underperforming. What impacted auto sector? Just because of one simple regulation government made. They skipped BS5, they moved from BS4 to BS6. Just one small regulation what government did impacted the entire auto sector. Now, the cost of diesel engines went up, the cost of vehicles went up, third-party insurance was introduced with bumper-to-bumper coverage for 3 years. So cost of owning a vehicle itself went up. And we were coming out of a fragile zone of GST and demonetization. The consumption itself was fragile at that point of time. When added to this, when the government came out with this policy, the sector started underperforming. This is what we call as sector traps. This white zone where the sector is underperforming, this is what we call as sector traps. Those are the periods where the sector will underperform. If somebody has stayed invested in those periods, in those sectors, they are losing an opportunity there. The opportunity cost is lost, the returns are also lost for the investor. So we will be able to avoid this kind of sector traps. We will only be investing only once the ranking comes into the top 5. We will be more interested here. For example, auto sector. If you look at auto sector performance from 2022 onwards, middle of 2022 onwards, it's been outperforming. Consistently beating NSE 500. Now, what impacted auto sector at that point of time? Because the EV, electric vehicle story, changed the market for entire auto industry. We got the PLI scheme, production linked incentive for automakers, especially electric vehicle manufacturers. That impacted the entire auto industry. So that's where the entire industry started outperforming. Right now, what has happened? Now, when you see this ranking, it's consistently increasing. That means to say there's a mark-to-mark gain. One, our allocation would also increased. When this ranking has changed from July onwards, that means to say we have been booking profits in auto from July onwards. Once we start booking profits, eventually in the month of October, auto has exited. IT has just moved in. This is the bottom line. The bottom chart is for IT. Now, this is the relative performance of IT sector. It was in momentum here. At that point of time, this was in the top 5 trending. Then it moved out of that, and then post-COVID, we have seen a sector trap for 2 years. The entire IT sector was in a sector trap. Now, what has changed for IT? We are seeing the discretionary spending going up. Why is that happening? Because the inflation is coming down in US, the interest rate cycles are coming down. So companies have got more money to park now, and then they are ready to spend more on the deals, basically on the IT deals. So that's impacting the entire IT sector now, and that's moving up. You can compare the performance of auto sector versus IT sector in the last 1 month. You'll see the difference. Auto has underperformed, IT has outperformed. The model is able to clearly capture that. So IT has just moved into the top 5. In fact, FMCG is in the 5th position now. That's also moving out, and financial services is trying to make an entry into the top 5. The top 5 sectors right now are your healthcare, consumer services, consumer durables, then your IT and health financial services right now. So FMCG is trying to move out, and financial services is also trying to come in. Last month we had auto and FMCG. Auto has moved out, IT has made an entry in the month of November. Now financial services is trying to make an entry now in the subsequent month. So those are we are able to capture those trends. So we're able to write the trending sectors. Now IT will be in trend for some more time. You can expect IT to be in trend for some more time. Now healthcare can be expected to be there in trend for some more time. So those are the trends we'll be continuing to ride. Provided now if government spending picks up, it might happen that defense stocks or even the capital goods sector or the renewable powers might also start performing. We'll be able to capture those trends. It's all about relative ranking, how the relative performance of those sectors perform. If we're able to capture that, that's what the quant model is designed for. It's able to capture those trends. When we're able to capture those trends, we're able to replace the existing sectors with the newer ones, which will be trending, which will provide returns to the investors. So thereby, the investor returns will always keep compounding over a period of time. When once I have identified the sectors, we take the stocks from only those sectors. We take the stocks from those sectors subject to a multi-factor model. The multi-factor can be a momentum, load rate, valuation, which I'm currently running for the FlexiCap kind of a fund. So we use a similar kind of factor models to run for within those sectors. The only difference here is, unlike a FlexiCap fund, we don't have a capping on the large, mid and small. The reason why we don't have a capping on the large, mid and small cap is because the moment you put a capping there, sectors like your sugar stocks or textile, where you don't have any large cap names, you'll be missing out on those opportunities. If you want to capture those opportunities, you cannot put a capping on the large, mid and small. So it's going to be a concentrated portfolio of only 20 to 30 stocks, not more than that. 20 to 30 stocks invested only from 5 sectors. So it's going to be a concentrated portfolio. There's no capping on large, mid and small. It's like a PMS running on a mutual fund platform. Many of you cannot offer PMS to your clients. It's like offering a PMS at 500 rupees at entry levels. And you can't do an SIP in PMS, whereas you can do an SIP here. And more importantly, third important thing, whenever you do some transaction in the PMS, it directly impacts the taxation of the investor. But here, it doesn't have an impact on the taxation at the investor end. When once only redeems, only he'll have an impact on the taxation. That's the clear-cut difference from an investor point of view. Now, how the backtest works. We backtested this for the last 10 years. So in the previous slide when I showed, the top 5 sectors had a lesser drawdown and also outperformed in the subsequent year. So even in this chart also. In the current year also we have been able to beat the benchmark consistently. We are able to deliver alpha. Point-to-point returns, we have a decent alpha against the sectors, against the different benchmark and as well as the sectors as well. Even if you look at the SIP returns, if somebody invests in an SIP model, even whether it's 1 year to 5 years or 10 years, it's able to beat the benchmark consistently and also the respective sectors as well. Now, rolling returns. This is more something important which people would tend to look at. Rolling returns are similar kind of a story. Almost close to 13% kind of alpha has been generated here in the back test. It's able to beat the respective sectors, respective benchmarks as well. Drawdown. If you look at the drawdown analysis, this falls lesser compared to even to the benchmark and also recovers much faster. Even in the month of October, when the index fell 6.23%, this model has shown a performance of only minus 5%. So almost 1.26% of alpha was generated even in the month of October also, in the paper test. So the long-term performance, if you look at the chart, if somebody had invested 100 rupees, it's worth 1,700 rupees, almost 17x kind of a return. Whereas the benchmark has returned 4x. So that's the power of compounding actually. So we split it up into 3 parts: pre-COVID, COVID and post-COVID. Irrespective of the cycles, it is able to beat the benchmarks. And to summarize, 3 major benefits. We're not putting everything in one single basket or one single sector. We are diversifying it. It's not a broad-based diversification. We are a focused diversification of only 5 sectors. And we are avoiding sector traps. We are able to rotate sectors at the right point of time, keep the trend active, and we are able to avoid any kind of sector traps for the investors. No FOMO for any investors. You can enter any point of time. You don't need to time the entry. If somebody comes and asks you when I have to enter into defense fund, when I have to enter into auto sector fund, this one will take care of that. You don't have to time it. You can time it automatically, the fund will time the necessary sector rotations. And third thing, relatively tax efficient. If the investor does this on or her own, they'll end up paying capital gains. By investing in this, the capital gains can be avoided, and then they'll end up paying capital gains only once they redeem the funds. So minimum 80% is invested in equities, 20% is kept provision for arbitrage or cash call. So that will be helping in kind of any kind of drawdown situation. So minimum investment is 500 rupees, and this for both lump sum and as well as SIP, and 1% exit load for the first 3 months. After that, there is no exit load. And the allotment is on 9th, and the reopens on 13 December. Factor model there. So we are using forward earnings, momentum, low volatility, and as well as other qualitative parameters like the sector specific parameter drivers. For example, if it's an auto sector, the monthly sales, all those numbers goes into the decision making basically. So it's a quant model which takes into account all these parameters. Most weightage is given to the price actions because price reflects on a day-to-day movements, so that will take care of it. Some of the trends are visible only once in a quarter or kind of a period. Some of them are forward-looking. So there's also a subjectivity coming into the forward-looking aspects always. So to avoid that, we always look at the price actions more closely.
There are so many units that are actually driving this.
Yes. Yes.
Why are restricting yourself according to those sectors most actually?
So one thing that we have seen with the benchmark, just compare any benchmark performance. It's only the top 3 to 5 sectors will be contributing to the growth of the benchmark, the positive returns of the benchmarks. Not each and every sector will be contributing to the growth of the benchmark. So the benchmark returns, if you look at from one period to another, it will be only few sectors will be contributing. That's what my study showed in the last 10 years. It will be the top 5 sectors or 10 sectors will give you better returns compared to having a benchmark kind of an exposure. The moment you diversify too much sectors, the return will also minimize. So rather than a concentrated approach, that's what the studies also have been showing in the past. It's all about that. And more importantly, the new age sectors, automatically it gets captured. It's part of this 19 sectors. So what we are next level, what we are trying to do is, for example, I'll just give an example of financial services. I can split financial services into 5 different subsectors: private banks, PSU banks, insurance, NBFC, and capital markets. So 5 sub-markets 5 sub-indices I can build. So what will happen is, for backtesting, we could not do that significantly. Many of the stocks were not present in the past. In the last 10 years, we were not there. So if I had to do the backtesting then the numbers will show different. So that decision making will be looking different. Now what will happen is, I am splitting up these sectors into much more smaller granularity. For example, capital goods, I can split defense separate. I can bring in power equipment separate, power and power switchgears and all those related equipment separate. The general manufacturing industry has a separate theme. So that will give more coverage. So that will give you more, the themes will get played out at that point of time. Defense as a theme will automatically get played out at that point of time. So it's a kind of quasi kind of a way to play the themes, also the sectors, both. That's the approach that we have taken. Sorry? Totally, AMFI has defined 22 sectors. We are gone with AMFI sectors right now. So going ahead, we'll be defining our own sectors and kind of diversifying further. So that's where we'll be building our own index. Today, when I had to build this project, this as a fund, so I had to benchmark myself with the existing indices. So NSE has got only 13 indices. I ended up making 19 indices. We compared all the 13 indices. Once we were confident that those indices were matched point to point and kind of performance to performance. So that's when we were confident on the index data. So today I'm confident that I can even sell the index data of the last 19 index for the last 10 years. So that much kind of depth of data that we have today. The sectors change can happen very over a period of time. For example, the minimum to the maximum. So normally what happens, the minimum is for 3 to 4 months. The maximum happens up to 67 months. We have seen FMCG staying for up to maximum of 67 months. On average, you can keep it around 5 to 6 months of an average a sector trend will play out. It's going to be a dynamic money management. No, sir. I have not put any weightage on the sector weightage. The maximum you can go is only 40%. The reason is 4 stocks per sector, 10% is the maximum weightage you can give to a stock. The thumb rule says you can go maximum of 40%. You can't cross that. So I'll be restricting number of stocks there. If the sector has got too much weightage from the factors, I'll be restricting the number of stocks. That will keep a check on the number sector weightage.
Thank you, sir.
Thank you.